My name is Caleb Jennings. I'm a partner with the Kambs Jennings Group of Compass Mortgage. And just a little bit about us, we're an independent boutique mortgage bank. So we underwrite our loans in-house. We fund our own loans. We have a really strong team that basically our motto is always close on time, always communicate with our partners throughout the transaction, and always get repeat business from our clients. We always focus on that. So with those things, we know that we can ensure a great experience for our clients and for our partners. So we're doing this webinar because we know that right now there's a lot of, a lot of sound, I would say surround sound going on saying that are we on a bubble right now in this market? Like prices have been going up. There's been a lot of busy time for us in the last 6 months. Are we on a bubble? And the fact is that the pundits or the media really has instilled a lot of fear in people. We've had clients come to us saying, I don't know if now is the time to buy because we're on a bubble. I heard we're on a bubble. And is this like 2006? So what we thought would be helpful for you as a realtor to be able to have facts to over the fear that your clients may have, because I think that can really help folks understand that actually now is a great time to buy. So I want to introduce my partner, John Kambs, and he's the best actually to do this presentation. He's been doing mortgages since 2003. So if anyone's going to be able to kind of cover with you, like, does this look like 2006 versus what we're doing on, John is the guy to do that. So John, I'm going to hand it over to you to do the presentation.
Hey, everybody. Thank you so much for joining us. And like Caleb said, I've been doing this since 03. So I went through the 06 crash and it was not anything not fun. So I do, we gotta respect our clients for the fear that, nobody wants to buy when prices are high and they come back crashing back down. But I do believe when you look at a factual basis of, simple supply and demand and a couple other factors that the environment we are in currently in no way, shape, or form really resembles 2006. So let me go ahead and start this. So as we all know, this is basically the CaseShiller home pricing index, and it's kind of the go-to for appreciation and home appreciation. So this is basically outlining how much the value and the prices of specific homes or individual homes on average have been going up. And this is year over year. So if you look from June 2020 or June 2019 to June 2020, values went up about 4.4%. But as you get to the right side of this graph, you can see that from May 2020 to May 2021, values have gone up a whopping 16.6%. And if you look at the numbers from June, July 2021, we were up at 18.6%, then nearly 20%. So with appreciation accelerating this fast, this is where you have the media coming in and saying, hey, we are in bubble-like conditions, the market's going to crash, etc. So there's a lot of different things, though, that we have to take into consideration other than price for homes. And this is a headline we've seen. Home prices are up 41% since 2006. So when you look at this, the one thing that the media does not tend to ever mention is that in 2006, rates were over 6%, where today rates are, when we did this, they were under 3%. They're a little bit, they're around 3% right now. They're a little bit higher than 3%, but much lower than when what rates were in 2006 at 6%. And actually rates were a little bit over 6% in 2006. So not only that, as we all know, supply is the lowest it's ever been in history, and it doesn't really show any signs of getting any better. But so we basically have kind of a perfect storm here, where we have the lowest supply that we've ever had in history. We have pretty near the lowest interest rates we've ever had in history. Interest rates are nearly half of what they were in 2006. But then we also have in 2006, people are making more money. And this is the average hourly earnings. So this is basically the whole public. So in 2006, the average hourly earnings was $20 an hour. Today's average hourly earnings are $31. And one thing to think about here is that people who are probably buying a home, since this is the average of everybody, people who are just entering the workforce, so you have people potentially earning minimum wage that most likely aren't in the market to buy a home, are being included in this average of the hourly earnings of $31. So if you took today's average hourly earnings of people that are actually in the market to buy, it's probably more than $31. However, incomes again are up a whopping 55% from 2006. So you have lower interest rates, more demand. There's more buyers in the market than there were in 2006. So lower supply, higher demand, lower rates, and more income is really what you see fueling this market. And the other thing that I think is huge when you take into account the fact that, people will say, oh, well, prices are 41% more higher or higher than they were in 2006. Yeah, that is true. But let's look at the actual numbers. Okay. So if you were to buy a $300,000 home in 2006 and the interest rate was 6%, your monthly payment would be $1,800. However, your household income was $6,000. Okay. That would be 30% of your payment is 30% of your income. Okay. Where in 2021, you take a 41% increase of that $300,000 property, it's now 423,000. The rate 3%, the payment is still actually $17 less than it would have been in 2006. And now with a 55% increase in income accounted for, the person making $6,000 a month last year or in 2006 is now making $9,300 a month. So it's nearly half of what, from a percentage of their income, what the payment would be. So when you look at this, we really see, and we as we all know, it's definitely slowed down a little bit. I think a lot of that has to do with the fact that there's a vaccine out now. The people that were, I'm in Chicago, I live in Chicago proper. I'm not going anywhere. I feel like a lot of the people that did get out of Chicago because of the pandemic and probably nationwide that got out of urban areas are done. And that's provided the slowdown a little bit. But if you look at 2019 pre-pandemic levels to now, we're still up 14%. And when it was back in June of 2020, I think we were up like 30%. So we've pulled back, but demand is still very strong. We don't see it slowing. I do see appreciation probably last month's. It's been basically like from a monthly appreciation, we've seen about 1.5 to 2% a month, right? And that's where you're getting 20% a year. They're saying, well, if it's 1.5 a month times 12, that's 18% annually. Well, the last appreciations came out at 1.2%. For last month. So it's definitely down a little bit. However, year over year, we're still at 19%. So I think your clients that I think are waiting for the bubble to burst and come in and get a deal on a home, we don't foresee that happening. I think they're just going to continue to lose out on, they're just going to continue to pay higher and higher. And then obviously the interest rate can go up. And but we hope to see a more stable appreciation to stymie this bubble-like conditions. Obviously, the longer we're at 20%, the more it could perpetuate a bubble if we actually are in one. But based on simple supply and demand and interest rates and incomes going up, we don't really see the 2006 condition in any way, shape, or form. And then not to mention, as Caleb said, I was in the business in 2003. And the mortgage industry isn't anywhere even remotely close to like it was in 2003 and in 2006. In 2006, if you had a breath and a pulse, you got a mortgage. Where today the quality of the mortgage originated isn't even remotely close. It's still, you got to qualify. You have to have a good credit. You have to have a decent down payment. You have to have income, verifiable income. So all these factors, we don't see anything like 2006. And if you listen to the media, I mean, the media for the past 8 years has been saying that the housing market's too hot. and had your borrowers or had our borrowers in the past and your buyers listened to the media over the last 8 years, they would have missed out on huge opportunities. And I think that'll continue to be the case. So hope you guys enjoy this. We'll go ahead and open the floor for any questions. And as always, just shoot us an email if you guys want a copy of this presentation. We can get that to you to share with your clients.
Thanks, John. And Jess, will you check if there's any questions? And
Yeah.
again, just while Jess is doing that, if you haven't worked with Compass Mortgage before, we're an independent mortgage bank. When you work with us, like, we will work with your client from the start, from the pre-approval to the closing table. And we definitely love taking your referrals. So if you have anyone that needs help now, go ahead and let us know, and we'll jump on it right away. Go ahead, Jess.
I forgot I muted myself again. Thank you. So someone's asking, and I think this might help clarify things a little bit too. Are there like core items, very like keywords that you use to help your clients or your borrowers kind of understand and kind of wash away their fears of, if they're coming to fearing a bubble?
Yeah, so I think that the best way to overcome those fears is transparency. And that transparency would be that I don't know anybody who can tell the future, and nobody technically does. So I don't know what tomorrow's going to bring. All I can look at what the past has done. And what I tell borrowers is that this is a long-term investment, and the longer the term, the shorter the risk. So if you're looking to buy in the next, and you say, hey, I have to move in 3 years, that's a lot more risky than saying, hey, I've got 2 kids, I need to get into my forever home. And the question becomes, should I rent or should I own? And the answer to that question is to buy, because if you look at the 30-year horizon, and even though we had a bubble and a meltdown in 2006, you're still better off buying a home 30 years ago. And so I would say that the best way in my mind is to basically tell clients that the end all be all of in my estimation of mitigating risk to buying a home is 10 years. And you plan for the worst and hope for the best. So if you buy a home and you say, hey, I planned on living here for 10 years, and turns out we were in a 2006 environment when I bought, and but I knew I was going to I planned on holding it for 10 years. So you can weather the storm. Where if you buy and you say, I need to move in 3 years, then you did buy in a 2006 environment, then you could get burned. So I would just say being transparent with clients and telling them that, and saying, hey, if you still want to buy and you need to move in 5 years, I'll help you. But I just want you to be aware that the odds of you, it's much more risky on a short term to buy and sell and make a profit than it is over a 10-year term. And I would say that that's what I've used that's worked in the past, and provided some solace to people that were worried about this thing.
Yeah, I think to John's point, it's just, being transparent about, we don't predict the future. However, again, the facts that we just laid out to you, rates are at all-time historic lows compared to when the market crashed. The supply is down, appreciation is continuing. That if they need a place to live, especially if they're paying rent, it's a no-brainer that now is the time to buy. I just got a text from one of our realtor partners, for some reason, who can't find the chat box, had a question. John, this is actually a question from Tom. He wants to know, like, then versus now, can you speak to your point of view on appraisals? So back in like 2006, 2003 appraisals versus now, like, how are they going through, not going through, et cetera?
Yeah, so that's a great question. And I would tell you night and day. When I got into the business, I could assign an appraiser to whoever I wanted. And I could basically say, I don't like the value that John gave me, I'm going to go and order an appraisal with Jess. And hopefully Jess gives me a better deal. And not only that, I could call Jess and say, hey, Jess, John gave me a bad a bad appraisal here. I told him I want 400,000 and he brought me in 375. Jess, can you get me 400,000? Jess says, oh yeah, John, I can get you $400,000. And since the crash, I'm not even allowed to talk to an appraiser, and I'm definitely not allowed to tell an appraiser a value that I want, and I definitely cannot choose the appraiser. So that those three factors have really, I believe, mitigated the amount of appreciation, or at least artificial appreciation, you saw in the market when you had appraisers being pressured to bring in higher values to get deals done. And then some things that are on the horizon that I think all of us need to be aware of is that in 2022, early 2022, Fannie Mae and Freddie Mac have basically said they're going to go to desktop appraisals for the most part. So we're going to be going back to where we were in COVID environment, where there is no inspection. They're going to go off the property pictures that are in the MLS. So I would say make sure you have good pictures. But that, and then so it's a I would say bittersweet, right? Where the great news is turn times are going to come down dramatically on appraisers, right? Appraisals. We have a property right now in Florida, and it's like, hey, minimum 2-week turn time to get an appraisal done. That's going to go away. The bitter of it is going to be, I've heard from a lot of agents that say, well, they didn't come and inspect the property. That's why I got a low value, is because they didn't see how great the property was. But the other things I think that are on the horizon from an appraisal standpoint that is very interesting that I heard from our chief appraiser is that there are actually some legislation coming out that's saying that an appraiser, if there is an inspection, an appraiser is not going to be the one to inspect it. It's going to be a third party that comes and takes measurements, takes pictures. And the whole notion is that the days of the listing agent meeting the appraiser there and saying, hey, these are the comps I pulled for you, this is what I need you to do, and maybe influence the value, are going to be gone. There's going to be basically no contact at all with the appraisal. So it's a very good point that if you look at the values now, I would say you could make the metaphor of like borrowing. The quality of the values right now is much greater than it was in 2006. As painful as it is when you get the property that doesn't appraise, I see it much more than in 2006 when, I mean, heck, we didn't like it a value. No worries, everybody. We're just going to send it to some other appraiser, and we can do that in unlimited, and we get to pick. So great question. And I think it's going to definitely continue to hopefully fight a bubble environment that we saw in 2006.
Yeah, and I think we plan on we're going to put together some best practices that we know from appraisers on these desktops too, because like John alluded to, like taking good photos and making sure they're on the MLS, things like that. So we're going to really try to help our partner agents make sure that they're prepared for this change as well. Any other questions coming through, Jess?
Yeah, thanks so much for highlighting that. One other question that kind of, I guess piggybacks off that. I know you mentioned, how the appraisals have changed since then, but anything else in the lending industry or within guidelines that, you think are key that changed that kind of help support that we're not seeing something similar to 2006?
Well, yeah, I think, you look at 2006 when I got into the business, I can't remember exactly, but I feel like the conventional loan amount was 417, and it was basically 417 for a long time. As I'm sure you guys have heard and seen from us, the conventional loan amounts are going up to conservatively 625. Fannie Mae and Freddie Mac has not announced an official number, so you have investors that are doing a conservative estimate and willing to fund to 625. The people that actually know these calculations are saying it's probably going to be more like 650. So I think that when you see the fact that you're going to be able to buy a lot more house for cheaper with a lot lower down payment is going to really help to maybe make up for the lack of sales that, or the decline we've seen. I wouldn't be surprised at all if next year you see all of a sudden the starting, you could buy a starter home for 3% down with a conventional loan for $670,000. So
So,
that is going to be huge, I think, and it's going to
and
continue
just
to
to clear,
appreciation.
sorry, John, just to
Yep.
clarify though, we right now, we jumped the gun, even though that this probably isn't going to be till next year. Compass Mortgage is now doing conventional loans up to 625,000. So if you have any clients that were on that jumbo conventional loan bubble, now they can go put 3% down on a $625,000 for a $625,000 loan.
Yeah, I think that's going to be huge. That's one thing. And then as far as other things, I do see, you do see some common sense underwriting coming back where, we'll do bank statement loans now where you have to be self-employed. And, but if you have a standard self-employed borrower who likes to write a lot of stuff off, and at the end of their write-offs, they only make $50,000 a year, but monthly they have $25,000 coming in deposits into their bank account. Well, we can get them a home. They're going to have to put more down. But you post 2006, it was like, hey, you either have on paper what you reported to the government or you don't get a home. Where common sense stuff has come back, but again, it's still verifying income. It's still verifying deposits. Where 2006 was, I remember it was, if you had a 720, you'd go no doc, right? There was no, all we did was pull a credit report and
You told
you got a
us.
home. Yeah, you had
Told us
to
what
have
you
a
make.
down payment of, I think, 5%, and you got a home, right? So there are no doc loans, and so I think the environment, the lending environment has been good to help the market, but it's not anywhere near 2006.
Awesome. Jess, any other questions?
I have one last question just sitting in here, and then you guys can wrap up unless anything else comes through. But do you see the appreciation value kind of tapering off right around that 16%, or could it possibly decline over the next couple of years?
Yeah, so we see it tapering off. I mean, and if you look at, just based on what we've seen, we've slowed down to a sustain, and our slowdown has been somewhat welcome. I think that it was unsustainable how 2020 was, and I see a more back to normal. But as I was kind of trying to illustrate, is that since it's year over year, you're still gonna see like, okay, like if it was 2% like from month over month, and then all of a sudden it goes to 1%, you're still going to be able to say to a client, hey, year over year you had 19%, and then it's going to have, it's a trailing year. So if you look historically, it's average appreciations is 3 to 5%. So I don't know if we're going to get all the way down to that. I think that the rates are going to really be are really going to determine that. And there's a lot of rumors out there that we could be headed for a recession, like before 2020 and before the pandemic, when everybody was thinking there's going to be a recession. I'm not sure if you remember. And then the pandemic hit. There was a ton of stimulus that came into the market, and then everybody. Yeah, it's just, I think it's very telling that nobody knows, right? Because like if you remember, I remember in March of 2020, it was like, oh my gosh, the real estate market's going to crash. Everybody's going into forbearance. There's a pandemic, like, and the exact opposite happened, right? Like everybody, the real estate market really performed well. But I think that hopefully I would like to see again more normal appreciation, just because when you have markets that are 20%, it would indicate a bubble. I don't think, and this, the way that that we're starting to slow down indicates to me that it's not a bubble. It was a run, but we're pulling back. So as much as I would love to see 20%, it's is it sustainable? And the last thing we want to do is I had somebody on Facebook who was like, oh, if we're in a 2006, should I wait to buy? And the one of the answers I heard was that I thought was very poignant, was that, like, I don't know anybody who went through 2006 and said, wow, this was great. Like, it was terrible, right? So hopefully appreciation will come back to a normal rate. But that being said, that still means that you're, as a buyer, you being on the fence and not in the game, you only lose.
But I like that.
One last question here, guys. Are FHA appraisals asking for less repairs than a year ago? Can you speak to that?
It's hard. It's hard. I'll speak to that. I mean, it's hard to tell on that. I mean, for what the desktop, I'll tell you what's nice is those desktop appraisals for FHA were great because we didn't have to have anyone go inside and get any subject to inspections unless the listing agent put it on the MLS that there was work that needed to be done. But so that's an upside for these automatic underwrite uh,
Yeah,
inspection waivers, right? Like, because then
but they
we
have
have.
just to they've said FHA VA are still going to be conventional. And just to clarify on that, conventional purchase 2022 desktop. So if it's a purchase, if you're trying to
Oh,
refinance, you may get an appraisal waiver, but there's probably going to be an inspection.
so
So
to your answer about FHA, it's still the same game. I mean, I think the key thing is that we like to, as our team, what we do a lot of FHA mortgages, and so if we'll look at the property ourselves right away online, what we can see, and help coach our partners on how to make sure the property's ready, so we don't get a subject to as well.
yeah,
But
and then just to clarify as well, nothing's changed. Like the same stuff that was going to
yeah,
be subject to appraisal for FHA is going to
always.
be a subject to appraisal today. They haven't lightened that at all. As I'm sure a lot of you are aware, we had one that we were like, oh, there's going to be major issues. They're going to want a lot of stuff fixed. And sure enough, came back as is, right? So a lot of it just depends on the appraiser. But obviously, if there's glaring things that are going to be an issue with FHA, there's still going to be an issue today.
All right, so we're coming on the end here. I want to thank everyone for joining us, and we're planning on we'll be doing a webinar in a couple weeks actually for you, tax tips for realtors. We're going to have an accountant that's going to help coach you on some things that you can do to be prepared for your filings as well. So look out for that. But again, John and I are always available to help your clients. You'll see our team line is right there, that 402-882-5626. Don't hesitate to hit us up. And if you have any further questions about this topic, I know John would love to talk to you for hours about it. So don't hesitate to reach out. All right, we
All right,
good?
thanks again so much. We are
Thank
good. Thanks
you.
so much for joining us,
Thank you.
everyone. And thanks, John and Caleb. Have a good day.
You too.